Hi, I'm Ellen Cookman, and we're doing a series about taxes involved in estate planning. Well, this time we're going to be talking about generation skipping transfer taxes. Now, this is kind of an unusual tax that we don't see come up that often, but we do have language in our trusts about this type of tax. So a lot of my clients are curious about it, and it also comes up when we're talking about Dynasty Trust. So I wanted to do a special video just on it. So as you know, each generation is subject to estate taxes. I did a video on estate taxes that you might want to watch, all right? And so what happens is when money is passed from one generation to another, it's subject to estate taxes. Well, some bright, rich people realized, hold on, what if I skip a generation? What if I leave money not to my child, but to my grandchild? Then it's not going to be taxed at the child's level. Well, in the 1970s, the IRS realized what was going on. And so they started imposing a tax on transfers to skip persons. That means from one generation skipping the next generation to the next generation, like a grandparent to a grandchild. This also could include a transfer to somebody who's 37 and a half years younger than you, because that's kind of considered more than one generation. This can also include trusts if each beneficiary of that trust is what we call a skip person. So each person has a GST exemption of $12.92 million. That's in 2023. So that's the unified exemption, the estate tax exemption, the gift tax exemption, and the GST tax exemption. So we each have that amount, but that exemption amount will be dropping to $6 or $7 million in 2026. The GST exemption can be applied to gifts during your lifetime if you make a gift directly to a grandchild, or gifts upon your death to a skip person. So one place we see this applied is gifts to Dynasty Trusts or bequests to Dynasty Trusts. We really like Dynasty Trusts in this office because they're very protective when it comes to if somebody's getting a divorce, all of your child's money stays with them, or if they're sued by creditors, then the money can stay with them. But Dynasty Trusts were really created for this particular purpose, all right? That money going into the Dynasty Trust for the child, upon the child's death, it goes to the grandchild free of estate taxes. What does that sound like? You're right, that is a skip, all right? That's really going from the grandparent to the grandchild free of estate taxes. Wow, GST in its prime. So what ends up happening is we allocate the GST exemption to those trusts through the estate tax return. So how do you apply this? Well, starting in 2001, the GST exemption was automatically applied to those estate tax returns. However, your accountant might want to allocate things differently. For example, let's say you have 3 children and 2 of them are typically abled children who have their own kids, and one of them has severe disabilities and will never have their own children, all right? In that case, you'd want to allocate upon your death, right? So the successor trustee would work with the accountant to allocate the GST exemption to the 2 typically abled children that you have. And then they can really, maximize that GST exemption to make sure that that money going to then the next generation, to the skip people, are free of GST taxes. So this is really a bird's eye summary because GST tax planning is very complex. But I did at least want to mention what it is and why we keep an eye out for it, and why we include some language like that in our revocable trusts. So hopefully this summary has been helpful for you. The next video in our series will be all about capital gains taxes. So I encourage you to watch that right over here, and I'll see you there.